How's it going today, guys? Welcome back to Stock Radar. And in this video, we're going to be talking about GE or General Electric. This was the company you guys voted on over in the private Facebook group. And if you guys are not a part of that group, make sure you click on that very first lecture. I think it's called Important or Read Me. It includes a link to access the private Facebook group and the password needed to get access. Now, this is not the traditional setup here that I use for Stock Radar because I had so much information to cover about GE and I have a lot of visual elements and charts I'm including. So I decided to do this entire presentation in PowerPoint form just because of the amount of information I have to share here on GE. But this is certainly not going to be the norm here. I'm going to be going back to the regular Blackboard presentation for other investments. Maybe once in a while I will do just a PowerPoint depending on what type of information I am sharing with you guys. But first of all, we're going to start off by looking at the history of GE and some of the basics about them. So first of all, GE is a company that has a 126-year operating history. They are a very old company, and they're actually based out of my area. They're from Schenectady, New York. I drive by the original GE location frequently, and you can see the big sign lit up, and it's kind of a cool thing in Schenectady to see that. But anyways, their price-to-earnings ratio, they're currently not profitable, so they don't have a PE ratio. But the reason why most people are looking at GE is because that forward PE is at just 13.8. That is a very low forward price to earnings ratio. So what kind of investment is GE? This would be a income/recovery investment. This is a stock that is in recovery mode. They have had terrible performance over the last year, and it's not an investment that's going to be turning around anytime soon. We're going to talk about why that is, but this is a very long-term recovery type investment where you're looking to get some income through those dividends because they do have a dividend yield of 3.28%. However, there is a problem with that, and that is the fact that because they are not profitable, how can they really even afford to pay that dividend? I mean, of course, they've been paying dividends for over 100 years. That's their dividend history. So odds are they're not going to eliminate that dividend, or else shareholders would absolutely panic, more so than they already have. But the fact is they really can't even afford the dividend they're paying now because they're not even turning a profit. Now, that dividend was cut 50% back in 2017, and that was one of the major catalysts that sent GE into more of a free fall. So because that dividend was just cut, they have a 0-year dividend growth streak, and this was the second dividend cut since the Great Depression. The only other one was during the 2008 recession. So now we're going to answer what is actually a very complicated question, and that is, what the heck is GE? What is General Electric? And if you ask most people this, they're going to say, well, they make light bulbs, I think they make appliances, but you really don't know much about them beyond that, because they are a very complicated company, because they're a conglomerate of different businesses. And really the point of GE is that they are a collective research environment. So they have all these different businesses that operate somewhat independently, but they collectively share research with each other. And the value of GE as one entity is that collective research and that shared research and knowledge and data. Now, a lot of people are talking about splitting up GE, and even the new CEO has talked about that. But the thing is, the real value of GE is in that collective environment, and if that was broken up into pieces, that might not make sense. But right now, all options are being considered, as far as I can tell, as far as what they should do to fix the financial problems that GE currently has. But there are multiple different arms of the business, and let's talk about some of those now. So first of all, GE Additive is a relatively new one. This is Advanced Manufacturing Technologies. GE Aviation is one of the core pieces of their business. They produce engines and components as well as other aircraft components. And then we have GE Capital. This is one of the problems for GE right now. This is the financing arm of the conglomerate, and they divested all financing avenues that were not related to aviation, energy, or industrial. So now that is solely what the GE Capital is involved in. And then GE Digital is new as well. This is software solutions for digital industrial applications. And this also includes IoT, or Internet of Things, where there's interconnectivity of devices. So they have this with their aircraft components and engines being connected to the internet. That way they can all communicate with each other. And then GE Healthcare, this is another core element of their business. They manufacture and distribute medical equipment. Primarily this is X-ray equipment they're well known for. And then GE Lighting, they are actually selling off this piece of the business, but this is a business where they create optimal lighting systems. And a lot of people also know GE for their appliances, but GE Appliance was actually sold off back in the second quarter of 2016. But that's not it. There are actually more businesses under GE. We have GE Power. This has been the big problem area for GE over the last year. They have power generation equipment. Then GE Renewable Energy. This is the alternative energy arm of the conglomerate involved in solar, wind, hydroelectric, different types of energy like that, renewable energies. And then GE Transportation supplies the rail, mining, marine, stationary power, and drilling industries. And then they also have a 62.5% ownership stake in Baker Hughes, which is an oil and gas service company. And then there is GE Current, which is the energy management system company owned by GE. This is still very new. And then GE Global Research is that research and development arm of the conglomerate. So that right there is what GE is. It's all of these different pieces working together. But the problem with GE right now is that a lot of the pieces of the business are not being run very effectively, and they have really turned into a bit of a cash-burning machine. We're going to talk about that more going forward. So first of all, let's go ahead and talk about the big mess for GE right now. Well, we know that the new CEO, John Flannery, replaced the former CEO, Jeff Immelt, and Jeff Immelt left behind quite the mess. So Flannery is selling $20 billion in assets over the next few years to focus on the core businesses, and they are planning to exit transportation, lighting, and the industrial solutions side of their business. And they've also talked about evaluating exit options on Baker Hughes, which is that oil and gas systems company that they have a partial ownership stake in. Now, another big problem for GE is they have a pension nightmare right now. They have significantly underfunded pensions. We're going to show how bad that is going forward. And currently, GE is borrowing funds to pay for pension liabilities. And the main criticism as far as the current decisions that John Flannery is making is that the turnaround plans are unclear, and the market really is not confident at all about GE right now. And Flannery also announced that he is open to a breakup of GE, breaking it up into separate entities, where GE would no longer be the conglomerate that it is today. It would be separate businesses, and a lot of people are in favor of that, and a lot of people are completely against that. But in a nutshell, Flannery inherited quite the problem here from the former CEO. He is selling off the non-essential parts of the business that are not being run very effectively or don't have great prospects, and they are really evaluating the entire business and considering whether or not this should remain as one entity. So here are the key challenges that GE is currently facing. The biggest one, in my opinion, is this underfunded pension nightmare, and we'll show just how bad that is in a couple of slides. It might even be the next one. And then there also is an SEC investigation on accounting practices, meaning they have to restate earnings from previous years. And then there is also potential litigation within GE Capital related to violating laws related to subprime mortgages. And then Trump's proposed tariffs on imported steel and non-US aluminum will really hurt GE, as this is an industrial company, if these tariffs are approved. And then GE, basically the big problem for them, or the main thing that caused them to be in this pinch, is the fact that GE branched out of the core industrial manufacturing businesses, and this caused them to become a cash-burning machine. As we said, they started spreading themselves way too thin, spending too much money on research, and really working on projects that don't have many future prospects. So what GE needs to do is to simplify the portfolio and focus on the core businesses again. And while that sounds simple, you need to understand that is no easy feat for them to do, especially being a company of this size. The bigger a company becomes, the slower moving they are, and it's going to be very difficult to make large changes within the company. So this right here is pretty much the reason why people are buying GE stock right now. This is a comparison of the forward PE ratio among GE, Honeywell, 3M, and United Tech. So this data here is as of March 6th of 2018, and you can see that GE has a forward PE of just 14.3. It's actually lower now because the stock has fallen even since then. And then we can see that Honeywell has a forward PE of 18.3. We see that United Tech has a forward PE of 18.3 as well, and 3M has a forward PE of 21.5. So remember that forward PE is the price to earnings based on the future earnings of this company, and as you can see here, based on this, GE is at a bargain based on the forward PE ratio, but do keep in mind there are a lot of problems that GE has to solve before they are a good value investment. The value is there at this point if GE is able to turn around, but it is possible that the stock could fall further if there was another dividend cut or if the company was possibly removed from the Dow Jones Industrial Average. So there are other things that could cause the stock to fall even further. But looking at the forward PE ratio, this is why some investors are starting to scoop up this hurting stock. So now we are moving on to what is probably the biggest problem for GE right now, and that is their pension nightmare. Now, they are not the only company out there with pension problems. In fact, of the 200 biggest pension plans offered by S&P 500 companies, 186 of them are not fully funded. And this simply means they cannot afford to fund the retirement plans for employees. And this is primarily due to low interest rates. Low interest rates have provided no good options for investments of pension funds. And GE has one of the biggest pension shortfalls. They have the biggest pension shortfall on the S&P 500 at $31 billion. So their pension is underfunded by $31 billion. Now, they don't have to pay all of that today, but that is going to need to be paid going forward, or they're going to have to restructure pension plans and retirement plans for current employees in order to get that pension back to where it is funded. So like I said here, the main problem is because of the low interest rate environment, because pension funds should only be invested in low risk and highly liquid assets. So these low risk investments, for example, short-term bonds, have paid next to nothing in this low interest rate environment. So they're not able to make any kind of return on their pension assets. They're basically just sitting there flat while the pension liabilities are increasing due to the low interest rates. So this right here is a visual showing companies with the lowest ratios of pension assets to pension obligations, and GE is on the bottom third from the left, so they are not the worst company on the list, but they are in terms of the shortfall in terms of the dollar amount. But Intel is actually the worst one on the list here. As you can see, assets make up just 46.6% of obligations, and if we move down and look at GE, we can see that assets cover just 67% of obligation. And then this here is a list of the most underfunded pension plans in terms of the shortfall, and as you can see, GE is on top there with a $31 billion shortfall, and the second one is Lockheed Martin with a $14.8 billion shortfall, and then Delta Airlines with a $10.5 billion shortfall. So moving on now, we are going to take a look at the quarter 2017 earnings report and talk about some of the key details there. So full year earnings per share came in at a loss of 68 cents per share, and total revenue declined 1% from 2016 to 2017. So revenue was relatively flat. There was a bit of a decline there, but that is definitely not the problem area for GE right now. So GE Power saw massive losses in 2017. This was the biggest problem area on this earnings report. GE Aviation and GE Healthcare had strong performance, and GE Renewable Energy did well, but that's a very small piece of their business. But those did well in 2017, those segments. And we know that the dividend was cut 50% in 2017. And looking at numbers like this with a loss on earnings per share, they can't even afford the dividend they are paying now. So it makes you wonder if they're going to have to make another dividend cut in the future. And then these are the segment results for GE. We see that GE Power profit was down 88% year over year, while revenue was down 25%. So that tells you that something is very wrong with that business if revenue declined 25%, but the profit was down 88%. Now, GE Renewable Energy, this is a small piece of their business, but profit was up 25% year over year, and revenue was up 15% year over year, so that was a plus. Now, as far as GE Oil and Gas goes, profit was down 25% year over year, but revenue was actually up 69% year over year. So again, that shows this is another problem area for this company, because if revenue was up 69%, you would expect profit to be up as well, but revenue was up and profit was down. GE Aviation saw profit up 2% year over year, while revenue was flat year over year. GE Healthcare saw profit up 13% year over year on revenue that was up 6%. And then GE Transportation was another problem area. Profit was down 40% year over year, while revenue was down 20%. Now, as far as GE Lighting goes, revenue was down 7% year over year. And the reason why we don't have profit figures there was because GE Appliances was lumped into the lighting segment in 2016, skewing the year-over-year results for profit. And again, GE Appliances was sold in quarter 2 of 2016. So moving on now, we are going to look at the financial documents. And I do apologize because typically I use the NASDAQ documents. I think they're cleaner and easier to interpret, but they don't have listings for all companies as far as the financial documents go, so this came from Yahoo Finance. But first of all, we're taking a look at the balance sheet and looking at the assets. So we can see here that current assets for GE have decreased every single year since 2015, and cash equivalents have decreased every single year since 2015 as well. Now, total assets declined 23.4% from 2015 to 2017. However, we do see that total assets increased from 2016 to 2017. And now we are moving on to the liabilities section of the balance sheet. So what we can see here is that current liabilities and total liabilities have declined from 2015 to 2017. However, total liabilities increased from 2016 to 2017. So current assets do have coverage of current liabilities at a ratio of 1.2 to 1 in 2017. And we can see that total assets also have coverage of total liabilities at a ratio of 1.2 to 1. So the assets and liabilities, this isn't really the big problem area for GE. They do have good coverage of their debts. However, the cash and equivalents has poor coverage of current liabilities at just 0.36 to 1 in 2017. So the balance sheet really isn't the big problem area for GE in terms of assets and liabilities. The problems lie elsewhere. And I pulled this off Yahoo Finance. This is a good visual to show the problems that GE is currently facing. I mean, just look at the numbers here. Does this make any sense to you as an investor why revenue would be at 120 billion and they have a loss in 2015? Or why they would have 120 plus billion in revenue in 2016 and earnings of just under 10 billion. And then in 2017, we saw a loss on 120 billion in revenue. There are serious problems going on within GE, and they're currently at a point where they're trading, their market capitalization is pretty much about what their revenue is, which is just mind-blowing. And then on the right there, we can see the quarterly data for this, and we can see that there were massive losses posted in the fourth quarter of 2017 on just over $30 billion of revenue. So moving on now, we are taking a look at the income statement for GE, and what we can see is that gross profit fell 46.2% from 2016 to 2017, while total revenue declined just 1.3% during that same timeline. So profit is down almost 50% on a slight decline in revenue. That indicates a big problem. Now we see net income from operations came in at a loss of $5.7 billion for 2017, and that stockholders' equity has declined every year since 2015. So we can see that stockholders' equity declined 15.3% from 2015 to 2016 and 34.6% from 2016 to 2017. And then finally, we're going to wrap up here by looking at the actual performance of this stock. So what we can see here is that GE stock has been in a free fall over the last year, falling 51.6% compared to an 18.6% return from the Dow Jones Industrial Average. Do keep in mind that GE is still a component of the Dow Jones Industrial Average, and it has been the worst performer by far. Now, GE stock was flat from 2013 to mid-2016, with a slight rally into 2017, but then everything turned sour for this company as they fell over 50%. And again, a big concern among shareholders is a delisting from the Dow Jones Industrial Average, as this is the worst performer, and it's going to take a long time for this company to turn around. And a bet on GE is a bet that this company is too big to fail. This is a company that has been around for over 100 years. They've made it through the Great Depression. They've made it through the recession in 2008, and people believe that this company is just too big to fail. However, it's going to take a very long time for this company to turn around. Now, the share performance, on the other hand, looking over the last year, makes this a classic falling knife for investors, and this is a falling knife that I got caught up in. I got into GE stock too early. However, I did keep in mind that this was a long-term investment. I'll be holding my GE shares for probably 5 to 10 years until there's a significant turnaround with this stock. But what I did is I only bought a small amount of shares at first. I took a small initial position, and then I would average down. And now I have my full position in GE, and I don't have as much of a loss as I would if I had bought all of my shares at once. So if you are somebody who is interested in taking a position in GE, I would highly recommend averaging down or maybe dollar cost averaging with these shares, because it could still fall further, even though we are seeing it maybe forming a base here in the $14 range. But my recommendation to you, and keep in mind guys, I'm not a financial advisor, but my recommendation is if you're a beginner and you're looking for a long-term investment, you might want to consider GE. But if you're going to get frustrated from flat or declining performance of a stock, or have the desire to sell if you see a loss, then you're going to want to stay away from GE. But if you're somebody who has had experience with buying investments or buying stocks low and then riding them out over time until they eventually trend upwards, then this might be a perfect pick for you. It's very infrequently that you get blue chip value like this. And looking at the forward PE ratio and looking at the market cap compared to the revenue, there is definitely value here with GE, but it's just a matter of whether or not this is the bottom for this stock. And again, don't expect any kind of quick turnaround for a company of this size. I would say it's going to be probably 3 to 5 years or more until we see any significant turnaround with GE stock. They have to completely redirect their sales, and a company of this size is very slow moving. But anyways, guys, that's going to wrap up this analysis of GE stock. I hope you guys enjoyed it, and I will see you in the next video.